Hi, I'm Rachel and welcome to Yield&Grace. As always, my videos are not financial advice and always do your own research before investing. Today's video is brought to you by Moomoo. You all know I'm always looking for apps that make my trading life easier, and I've been using a new one lately that I've honestly become obsessed with because it's so useful. One thing I really love is the organization. Everything is laid out so logically. Crypto, stocks, options, ETFs, all in one place, and the navigation is super smooth. Look at this. Moomoo gives you free real-time quotes, including options and level 2 depth. Normally, you have to pay extra for that on other platforms. They also offer zero commission on stocks, ETFs, and options, plus zero contract fees for equity options. And if you're someone who trades at weird hours like I do, they even have 24-hour trading. And when I saw that they have over 28 million users globally, I was like, wow, this platform is legit. They operate in major markets and have a big global presence, which I personally like. And if you want to check out ETFs, the ETF page is super clean and easy to browse. Whether you like crypto ETFs, high dividend ETFs, this has it all. Everything is organized for you. Right now, they have a really good welcome bonus. You can earn up to $1,000 in NVIDIA shares and 8.1% APY on your uninvested cash when you use my link below. So if you want a clean, powerful, feature-packed trading app, definitely check it out. If you've ever looked at your ETF's tax breakdown and saw return of capital, you probably thought, am I getting my own money returned back to me? And technically, yes, but kind of. In this video, I'm going to be breaking down exactly what return of capital is, why so many high-yield ETFs show it, and why I actually like it, especially for my income strategy. Return of capital, or ROC, happens when part of the money your ETF pays you isn't classified as income or capital gains. Instead, it's considered a portion of the capital you already invested. It sounds scary, but return of capital is mostly a tax classification, not a performance judgment. So, when an ETF writes a covered call, like many YieldMax funds, some of the premium they collect doesn't count as traditional income under IRS rules. A lot of people online treat return of capital like it's guaranteed proof of NAV erosion, like your ETF is literally giving you your money back because they're losing money. And that can happen, but not always. Return of capital does not mean the fund is automatically falling apart. It just means the cash flow source doesn't meet the accounting definition of income. For example, with covered call ETFs, part of the distribution is from the option premium, which can legally be labeled return of capital for tax purposes, even if the fund's NAV is stable or rising. So now let's talk about why I personally like return of capital, especially as someone who's building income through these high yield ETFs. Number one, it's tax efficient. Return of capital isn't taxed when you receive it. Instead, it lowers your cost basis, meaning you don't pay tax on that portion until you eventually sell. For someone like me who reinvests my distributions, that's an advantage. I'm deferring taxes while allowing my income to snowball. If I bought $10,000 worth of an ETF and received $1,000 in return of capital, my new cost basis is $9,000. I don't pay tax on that $1,000 now, but when I sell later. Number two, it keeps my cash flow consistent. Return of capital helps ETFs maintain a smooth payout schedule. Even if the fund doesn't realize a ton of income that month, it can still provide steady distributions, which is key for those of us relying on that weekly or monthly income. Number three, it creates predictability. I prefer knowing I'll receive consistent cash flow even if some of it is technically return of capital. That's what allows me to plan my reinvestments, pay my margin interest, and build my long-term strategy through compounding. Number four, it's not a red flag, but a signal to monitor. If I see return of capital, I don't panic, I analyze. I compare it to NAV trends, and if the fund's NAV is stable, the return of capital is probably structural. If the NAV is trending down sharply, that's when I will investigate further. So let's just do a hypothetical example. Let's say Platy reports a portion of their distributions as return of capital, but when I track my net/net income, meaning the total cash I've received in distribution minus any NAV erosion, the overall result is still positive. And that's truly the metric that matters most to me. I'm focused on whether the income outpaces any erosion over time, and in my case, it does. So therefore, return of capital does not scare me because I understand it. People who usually panic over return of capital are the ones who don't understand it's just a tax label and not a sign of failure. I invest for income and not optics. As long as my income supports my lifestyle and my portfolio stays balanced, I'm happy letting the return of capital flow. So the next time you see return of capital on your statement, don't freak out. Ask yourself, is this destructive or is it strategic? Because for me and for a lot of investors, return of capital is simply another way the fund delivers cash flow efficiently. And that's why I actually like it and why it is part of the plan. Discipline, income, and understanding, that is Yield&Grace. Thank you so much for watching. I appreciate every single one of you, and I'll see you in the next video.